Ben Maldonado is with us. Ben alerted me to this top, and his line of the sand at 3,200 was spot on. Hi, Ben.
Good morning, Dale.
Hey, welcome back, buddy.
It's good to be back.
So, I want to acknowledge that you did let me know when we were up around that after peaking around 33.90 and whatever, and we started heading down. You said 0.9 was in, and also while we were still heading up, your last interview, you had a 3,200 line in the sand. Yeah.
Why don't we guide him to share the screen first? Yeah.
Yeah, Ben, do you remember how to share the screen? You go to the green box.
I think I'm sharing it right now. Am I not?
No.
No, not yet. We don't have anything coming through.
Let me see. I tried to
green box and then the screen
green box, and then you're going to get an extra screen asking you. Yeah. Now something's coming through. Yep. Now we can see.
Okay.
We can see your. Is that your Twitter?
Yes.
Okay.
Yeah.
Good.
And we see the whole universe every time you do it. So tell us, tell us what you're seeing in the cosmos here, buddy. And you went to Wharton. Was President Trump one of your classmates?
No, but he did come speak to us one time as I was an undergraduate, and it was an interesting thing. I do have to give him credit. He had a great line. This kid stood up, this kind of cocky kid stood up, during the question and answer, and he asked Trump, Trump had finished his speech and everyone was all excited. And he asked Trump, he said, Mr. Trump, he wasn't president then, so it was Mr. Trump. He said, we have a lot of prestigious alums that give a lot of money to the school. And, I just want to know what you're planning on doing to match that or to be a part of that. And the guy and Trump, the whole place kind of was like, oh, and, started laughing. And Trump says, what's your name, son? And I can't remember his name, but let's say he said, Dan. He goes, I'll tell you what, Dan, I'll match you dollar for dollar.
Yeah. Dan was broke.
That's, of course, he's a college student.
Yeah. All right. So that is a good one.
Yeah.
Yeah, he knew. Yeah. Well, that qualifies him to be president. Good line.
Right.
So anyway, you are here. So let's talk about what you're seeing here. And I forgot the analog to Corona was what, AIDS, Ben? In that time frame, or what was it?
No, I was checking that there was no real pandemic type of thing in the 70s, so I didn't get any connections there.
Okay. Right.
But what we're seeing here, and I'll give people an overview that haven't seen this before. When the first time I was on Dale's show, we discussed this in May. I've been following this analog for about 15, 16 months, and the cycles that we are experiencing now are linked to what people went through in the 70s. And so through my cycle work and then looking sort of at the big picture view and checking to see where this lined up, the period in the 70s and specifically the S&P from 72 to 75 played out in this way. There was this megaphone pattern where you could identify 9 different points within it, and then we made a high and we rolled over. And in looking at why are we connected or how are we connected with that? Some of the examples that Dale and I talked about previously were President Nixon at the time was battling with the Fed. Well, Trump's battling with the Fed. Nixon declared the press was his enemy. Well, Trump has declared the press as his enemy. There was the Nifty 50 back in the 70s. And today we had F.A.C.E, where people are concentrating in a few stocks and pushing the indices. Even further, there was a president that was connected with China. Nixon was the first president to visit China. Trump is engaged with China in a different way, more of a trade war. Here's the big one that came up. Impeachment.
You know what the big one for me has been, and then I'm going to let you go, is that we were dealing with a megaphone formation that everyone was paying attention to, just like we had that you have in red on the left-hand side. Mm-hmm. And then once we had the throwover and accelerated above it, people have a short attention span and they go, oh, well, there's another formation that didn't work. But all it did was have a throwover, and then next time back inside, just like it's happening now, it was back under, I'd say, 3,100, took us back inside the megaphone. The megaphone is still valid. And
absolutely.
so,
and we'll see it on the next slide when I update,
okay.
when I show you how the analog is transferring to today.
Okay.
One of the last connections was the impeachment of a president. It's happened 4 times in the history of our country. Trump and Nixon are connected.
And neither were impeached.
They were both impeached and neither was convicted.
No, that's it. Yeah.
Yep. Both impeached, but neither convicted because Nixon resigned and the Senate acquitted Trump.
Right. Interesting. Yeah.
The last one that I'll tell you, which possibly could play out, is in 72, we had an election of Nixon versus George McGovern. Could we get Trump versus Sanders? It's possible. If it does, it fits perfectly. McGovern was a ultra liberal. He ended up getting killed in the general election, but the hatred of Nixon was so great that the Democratic Party went so far left and nominated someone like McGovern. It could happen again with Sanders.
Interesting.
Yep. So let's go to the current. Let's see where we are on this. As Dale said, he and I have been talking about this, and I messaged him when I thought 0.9 was in. But as you can see,
I wear bell bottoms when I interview you.
Right.
Go ahead, man.
You get your VW bug with your peace sign on it.
Yeah.
So we made the 0.9 high and have come down very sharply since. What I've drawn out in yellow here, and I'm not very good with the drawing tools, so it's pretty rudimentary, but it just kind of gives you an idea of the speculative path that we're looking at going forward, provided that we continue to follow this analog. Steve has laid out the case this morning. And as Steve was talking, it was like I gave him a preview of my speech because he's hitting on a lot of the points that I'm going to discuss. What we have now, this 0.9 high came in. And I'm going to go over what I call sort of like the anatomy of a top for the next couple slides to show you how we sort of triangulated that. We're in the process of putting in this initial low. I agree. I think we make a lower low first, then get a rebound. How big that rebound's going to be, we don't know. We'll have to see, how things play out. But there'll be a nice healthy rebound, and then we're going to turn lower again. So the key thing here is we don't use the analog as like, oh, this is gospel, this is how it's going to go exactly. We use it to see if the cycles are helping us pinpoint sort of timing.
And they give you a bias.
That's right. It gives you a bias. It gives you a way to a speculative path to look at. And as long as price confirms, and that's the most important thing, as long as we have price confirming, then you can say, okay, the analog's working. Let's follow along. The top. How did we find the top? Couple of things. So, what we like to look for, and what I like to look for when we're looking at the market timing issue here is combining cycles with price action with some sort of geometry. So we get a price, a time, and then confirmation through the market through price action. This chart here is the ES monthly, and at the exact top, we ran into significant geometry at that high. So when we hit that price, we could say, okay, if we turn down from here, this is significant. We hit that price in a cycle window, as shown on the analog. We were looking for this price, this 0.9. So we hit a significant price at a significant time. That sends the alarms off, right? Now we're just looking for confirmation from price. Here's another way to look at it through the SPX. And this one is set from 1982 when the whole bull market took off. You can see way up in the right corner with the red arrow, again, significant geometry at that high. So we've got we've got the time, we've got price. Now we need price action confirmation.
Yeah.
This is the ES 60-minute with the arrow on a bar where after this bar, I had another very strong piece of evidence that a top was in, something had changed, price action was giving us a strong signal. And what happened there? What was going on? All through this uptrend, we would sell off on news. We would sell off on some sort of event, whether it was the trade deal's on, the trade deal's off, we're close to this, we're close to that. This selling came out of nowhere. There was no news. There was nothing on the tape, but it was strong, big, aggressive selling. And then the rebound was tepid. There wasn't a strong snapback like we had seen on the way up. There wasn't this, aggressive buying that just, blew us right back to the spot of the decline. And so it was a strong signal in terms of price action that, hey, pay attention, something's changed. And it was in a cycle window. It was with price having achieved an important high. So all these sort of things lined up, a lot like Blake was describing this morning in his yen trade, which is, I had this resistance, I had S&Ps in this gap, we filled the gap, this, that, and the other thing. He had enough evidence that it gave him a high confidence trade. Well, here, this was sort of things lining up, price time, price action, where we could say it's looking pretty probable, with a high probability that we've turned, that something's changed. And Dale, you mentioned it. Here's a couple tweets that I put out with the dates on them, talking about the change in price action, that the character of the market changed. Things are different. So we have to act differently. We have to think about, okay, what are your strategies going to be? What are you going to do? And this slide, I think, and Dale, you're uniquely equipped because of your experience to talk about this. When the market changes, you must adapt. You must change. The biggest thing that new traders who have never been through a bear market have to understand is what worked really well in the previous bull market is the exact thing that's going to ruin you in a bear market. And when I was trading 20 years ago,
I was adapting a little early a few times, Ben.
Yeah.
Before the market changed, I was adapting.
Right.
So,
and that's,
anyway, I'm just saying that, sometimes you're better off not really looking too far ahead, because, I've thought this was going to happen for at least the last year. So, a lot of false attempts and some blood transfusions necessary to stick to it and stay at it. But that's something else. Don't adapt to the change until the change.
That's right. Wait for the market to change. When it tells you through price action, through the tools that you use, when it tells you that things have changed, you must adapt.
Yeah, the lesson I learned over last year is you don't have to be the first one. You don't have to be the pioneer.
No, pioneers generally end up with arrows in their back.
Yeah,
So the key thing here is, and I'm saying this for people who are new to trading. If you've never traded through a bear market and you have terrific gains from the bull market, do yourself a favor and get to cash and sit. Somebody gave me that advice in 2000 when I had never been through a bear market, and I didn't follow it. I was cocky. I said, you know what? I can do this. Look how much money I made. I know how to do this. This is not that difficult. And the job of a bear market is to take all those bull market gains away from people that don't have a real edge. All the bull market geniuses. So if you can learn by watching, by having experienced a bear market without experience the emotional and financial pain, you will be so much further ahead of the game. And it's it's not a thing that a trader wants to hear, like, oh, get to cash. But getting to cash and preserving your capital and waiting for the right moment is the best advice I could give people who have never traded through a bear market.
Return of capital rather than on capital.
Absolutely. If you can hold on to those bull market gains, that's a huge victory in a bear market. You don't have to add to your stack. Just hold on to what you made, and you'll be super far ahead. One of the things that people have talked about was, and I still hear people talking about it when this decline started, is that the Fed has your back. Don't worry. The Fed's going to be there. The Fed will take care of you. And guess what? That worked miraculously for the last 10 years, right? Any dip was bought. The Fed came in. They backstopped it. There was the Fed put, the plunge protection team, whatever people call it. The Fed did have your back. I think that tide has turned. And the next chart is going to show why I think that. Here's a list of all the emergency rate cuts the Fed has made since the early 90s. There's two that worked out really well, 94 and 98. And they were done in isolation as we were moving strongly in an uptrend. Look at the clusters where you have 3 rate cuts, 2000, 2007. And then look at where we have the first rate cut at this time. I don't think the Fed's going to have your back. If you're relying on the Fed to bail you out, I don't think it's going to work. They're probably going to cut rates again next week, so we're going to get a cluster. And they're probably going to cut rates one more time. So we're probably going to have 3 rate cuts in this environment. If history is any guide, it didn't work out well for people that bought because they thought the Fed had their back.
Yeah, that's interesting.
Yeah, it's telling because we've been trained for the last 10 years.
Yeah.
That if the Fed cuts, if the Fed comes in,
BTFD, that little cartoon that people have played for a decade now.
Absolutely. So the question is, what do you do? How do you adapt? And you guys have done a terrific job at ForexAnalytix talking about what you need to do and ways you can change. Reduce your trade size. Sell the rips. Don't buy the dips. Buying the dips worked before. Selling the rips is probably going to work now. Trade less. Trade higher time frames. So you are trading less. These are the types of things that if you're going to trade and if you're in there and you believe you have an edge, and remember, unless you are doing what is based on market truths of things like price action, Elliott wave, market structure, you don't have an edge, right? Those are the things that'll work in a bull market. They'll work in a bear market. They work in any market. Buying the dips only works in a bull market. And this is the key thing that we have to remember. One of the things that we do daily is we put out these fuse lines that we've talked about. And I just want to quickly show a couple of those that, show something that, it's worked really well in the bull market. And I want to just show people how it's worked since the market broke and things changed on the 20th. The red thick line here is the first fuse of the day. The lighter red line is the second fuse of the day. And this is basically a line that you use to know when price is above it, you got to look for bullish setups. When price is below it, you look for bearish setups. This is the chart from the 20th on the day we got that big seller that changed the character of the market. Here we had, we got caught down below it, tried to get back up, huge sell-off. Next day later in the day we rally back up into it, can't get above it. And these aren't cherry picks. I'm just going like 3 or 4 days right after the market changed. Here's your fuse line. You know that if you get stuck below it, you need to look south. Came down, broke the trend line here. There's your sell. Same setup on the one later in the day. Got below it, broke the trend line, you get the sell. Next day. Rallied up into it, can't get above, you got to sell. Rallied up into it, can't get above, you get a sell. Later in the day, rallied up into it, get a sell. And this is, again, another tool that helps you, limit the field in the market, define where you have an edge and where you can take a trade where there is an edge on your side. And as Blake said, if you're trying to trade in here, where's your edge? If you're trading up against the line and you're trying to sell it, there's an edge.
Okay.
Last one came on the next day. Very simple. Gets below the line, tries to break above it. You can put a trend line here. You can sell it on the pullback there. You can sell it on a break here. Also, what I wanted to do was do a little review of the last time I was on.
Yeah.
The last time we spoke about some themes for 2020. Volatility was one, inflation was one, and commodities. We have a big check on volatility. Volatility's kicked in higher. Inflation, we've got none so far. And no signs of inflation in any of these inflation gauges. The one thing we can look at and say, this is still a work in progress is if all this monetary easing and fiscal stimulus trying to do is going to find its way into the real economy, it's going to create inflation. On the chart here, we have monthly beans. It's still triangulating, sort of getting itself wedged into an apex here at some point. We're either going to have to break down or we're going to break up very strongly. My bias here is that we break up strongly, but price has to prove here. The grains, as well as other commodities, have been under pretty big pressure with this market weakness. Monthly gold. Gold hit the target that we discussed, one of the targets that we discussed from the last show, 1686. I still think we have much higher targets to look at. The monthly is pointing up to the 1775 to 1935 area, two different targets. I'm looking to be a buyer of gold if we get a pullback, into the 1613, 1600 area. I'm pretty bullish on gold longer term.
Okay.
Crude. Crude is interesting in that it's come down right to pretty strong support from early 2016, and so far it's holding. If we can put in a higher low on a pullback, I'd be willing to trade crude on an upside try, on a shorter time frame. But I got to see it, be able to put in a higher low on a pullback. Right now, it's in a weak position, and until we see that that sort of technical information that we've got a higher low, we've got buyers coming in, and that was a good low, I don't think you can trade long crude.
Okay.
Here's the 10-year. 10 years is interesting in that the high we made yesterday was in pretty significant and important geometric resistance, which may cap this for a while. And a lot like gold, I think, we're in a period where we may see some sort of, sideways consolidation in the treasuries. The market's certainly extended. It's very bullish. As long as we remain above this geometric support resistance line, it's going to be,
like 150. I mean, that pattern would measure the breakout from there, 150.
Absolutely. If we can break out and exceed the high that we made yesterday, 150 is the target.
I'm just talking about like the, your red lines, like a neckline right there where it came out, and just the magnitude of the formation arithmetically would take it there.
Absolutely. And
that
up here
holds.
Up here we have the geometric support resistance, so it's in that 150 area. And these circles are interesting in that, in the ways in which we use them are kind of unique, is that it's not so much to say, oh, the price is going here, or the price is going there, but it's to define the timing of the move. So as long as we're inside this circle, the move that's occurring can continue to go. When price breaks out of the circle, you generally see some sort of retrace or potentially reversal. So there's time left here. If we go back to gold, no, that's crude. You can see what happened here when we broke out of the circle on crude, right? We're following the circle nicely, getting a nice up. We break out of the circle, and there's your reversal and your weakness.
That's interesting.
Yeah. And then gold, here's gold. So gold, again, we've got time, because this is a monthly. So we've got time to make continued moves higher and continue to follow the arc of this move. So it's a very, in summary, we're in a volatile time. I think you need to have an edge to be trading. You're not going to get away with the mistakes you got away with in the bull market, and having these fundamental truths that are backing you, mainly being price action, support, resistance, market structure, and geometry. Those are the types of things that are going to guide you through this.
Great presentation, Ben. You want to show the attendees and people who watch a video how they can find you?
Yeah, sure. Let me get back to that.
Okay.
You can find me on Twitter there.
Okay. At Benji Maldonado.
That's right.
You want to show your website?
I actually don't have it up right now, but it's no worries.
Okay. All right. Well, Ben, thank you so much for updating us. Keep up the great work. Really enjoy having you like a regular in F.A.C.E and, contributing to our sessions. And I hope that you and your family are safe and healthy, and that the circles that you draw are filled up with happiness for you and everyone you work with.
I appreciate that, Dale. Same with you. Stay safe and be careful out there.
All right, man. That's a wrap for us today on Turnaround Tuesday with Ben Maldonado. Could find him at Benji Maldonado, and very interesting work. Those circles are certainly something that I don't see many people work with, Ben. So nice original work, and you're my trading warrior brother till the end of the bear market and the beginning of the new bull market in 2045.
Absolutely.
All right, partner. So that's it, everyone. You're welcome. And remember, don't just count your pips, count your blessings, and reduce leverage. And the only thing that I do a little differently, Ben, to trade larger time frames. If you want to trade, I even saw Steve Volge had a 15-minute chart up. Steve Volge, a 15-minute chart. So narrow your time frames so that you can narrow your risk and just be opportunistic. Very difficult to be a position trader in this environment. If you can do it, congratulations to you. But the kind of ranges we've been used to, you could capture them with shorter term time frames and not have to risk 200 pips on a trade. So we'll see everyone tomorrow. See you in the chat room. Adios. Thanks again, Ben.
All right, Dale.